Well, hello, everybody, and welcome back to the last Tuesday of the month of February, which means we are going to have our little podcast called The Long Term Angie's Advice for Agents, and probably more so Angie sharing with other industry experts that she wants to bring on the podcast and just kind of talk about a variety of topics kind of surrounding the industry, whether what's going on, what's happening, what are we seeing. And so I am very excited to have with me on this month's podcast Larry Moore. He is with National Guardian Life. But the great thing is as I invite these industry experts to come on, we're not doing product plugs, we're not doing, hey, look at me, we're the best carrier. And that's what I love about all of the carriers that I work with. They are so more than willing to just share things to be able to bring awareness around extended care planning. And so Larry and I couldn't be more excited about our topic this month. And it's really over the topic around the power of leverage. Because if you'll notice as we go through this month's podcast, we're not even really going to talk about long-term care insurance. We're going to talk about truly the power of leverage and what it brings to the table for clients. And Larry, I think you would agree, right? We can say this is pretty much with most insurances. I mean, whether it's your car insurance, your homeowner's insurance, really what you're doing is you're just transferring a risk to an insurance company, putting pennies in to get dollars out in the event that there was a catastrophic risk, a catastrophic loss. And I think we should view extended care planning really the same way because, it's not just wealthy folks. It's not just that wealthy folks understand this. Of course, they get the power of leverage, right? That's how wealthy individuals became wealthy. Um, but you have some really great ideas around this and what that power of leverage does. And I think it we're just going to have fun having this conversation around this today. So, what are you seeing? What are you hearing out there in the industry?
That's a great question. Thanks for having me on this morning. Yeah, it's so interesting. Something as basic as what insurance is all about, creating leverage that you couldn't create anywhere else or in any other way, right? That's what's so interesting about this topic, is it's so basic and fundamental to risk management. And that's what we're talking about with long-term care planning or long-term care insurance. And, I think the initial bias probably against long-term care insurance, especially from a planner's perspective, is that they've, first of all, kind of see it from the perspective of what our industry has done, galvanizing the issue that this is just not a glamorous topic to address. They're all about building hopes and dreams, and then suddenly the great big thud. Oh, now we're going to talk about when you're old and sick and in a nursing home. And it's, I think for them, it's an uncomfortable conversation because they want to talk about optimism, when in fact what we're doing is we're protecting optimism. And I like to look at this whole topic of leverage from really a money manager's perspective. And I say that because what we're talking about is not only efficient use of capital, we're talking about something foundational to the entire planning process, a way to protect the plan, right? Mm-hmm. So all that we're doing, as simple as this is, all that we're talking about is maximizing the efficiency of capital and utilizing leverage on a tax favorable basis because the plan structures are tax qualified under IRS code 7702B, which means not one penny of the distribution from this strategy is considered taxable income. Yet it's a way to address effectively the reality that your cost of living could triple or quadruple overnight should a long-term care event unfold. And then when we talk about should a long-term care event unfold, I know we'll get to that topic. I also want to just implore that we don't think about this as just, an old sick person's insurance type planning. It's a disability play. I don't care how you look at it. When you look at how the insurance works, it either asks if you're physically disabled, which we utilize activities of daily living to measure that, or that there's a cognitive issue, brain injury, something along those lines that requires supervision. So right then and there, it takes the whole idea of age out of this thing. Now, of course, the older you get, the more likely is you may need this, but we often don't think about the Christopher Reeve, the Michael J. Fox, or the Patricia Summit scenarios of young
Right.
people, who need this. So anyway, that's a perception. Once we get beyond that, then suddenly this is just clinical risk management.
Absolutely. And I love that because, excuse me, we haven't even really, uh, who wants to have that conversation? And maybe that's a little bit of our reluctancy to have this conversation. But I set Google alerts, and I like to read kind of what's trending out there in the way of people throwing out the word long-term care insurance or extended care planning. And I just recently came upon a survey, and I couldn't think, the phrase carpe diem just lands in my brain right now because we could not be in the better perfect storm right now to have these conversations with our prospects, with our clients, our customers, because it is very top of mind. And talking around this whole conversation around the power of leverage, who doesn't want leverage today? Everybody's looking for leverage inside their retirement portfolios, inside their, assets under management. And there was a recent article that I read, I think just last week, about how women are more worried than men are about senior healthcare costs, which I kind of laugh at this because it says, Medicare enrollees that are age 65, 66% of women said they're concerned about their ability to pay for it, compared to 51% of men. Well, 66% or 51%, that's still a pretty that's a high worry. Why wouldn't we? And then, of course, you've got all the news going on right now about nursing home, and you die in a nursing home. And I'm hearing the punch phrases and the taglines that's being thrown out there by the media. And we really need to seize the moment, not fear tactic, but talk about the strategy. Just like you mentioned, the likelihood of needing care as we get older. And if we don't believe it's not a disability play, go check how many GoFundMe pages are started on a routine basis, on a daily basis.
Right.
This is such a different conversation. It's just so much fun, changing the words around extended care planning and really showing them the power of leverage. And you've got a really cool approach to this. We all in this space have to talk about something that nobody wants to talk about, and it's not a tangible thing. I mean, insurance is not something that we all proudly carry our identification cards in our wallets and show them to everybody to be the proud card carrying members of a long-term care policy. We don't do that. So it's really not a tangible thing. We need to talk about it because nobody wants it. But the devastating effects of what it can actually do to your portfolio is just striking. And individuals just need to understand that there is a way to mitigate this risk, and it's really leveraging your dollars.
Right. And I think if you're a financial advisor, you should get what I'm about to say. If you're an insurance agent and you don't manage assets, listen to this concept, because what we want to do is get you away from pushing product and building strategy. All that insurance is, it's a strategic form of funding in a more efficient way. So, I often think about if I was a portfolio manager or if I was an investment advisor and I was on an analyst call. And on that call, the analyst, who maybe I would really respect, maybe it's a well-known person, would say that based on the current macroeconomy, there's probably going to be about a 70% likelihood of a major correction, maybe in the tech sector. We don't know. The fundamentals are looking pretty grim. Now, if I was on that call, do you think that I probably would make just a few phone calls to my best clients at a minimum just to stay ahead of what the news might be? Right? I mean,
Yeah.
it really causes a sense of urgency. Well, this risk shouldn't be treated any different. But I think this risk is even scarier because there is a 70% likelihood it can happen after, upon reaching age 65. But here's the problem. We have no way to predict the cause. We have no way to estimate the outcome in terms of duration or exposure. All we know is that your cost of living as a result of this will potentially double, triple, or more overnight. And we have no idea to guesstimate how long that impact will last. All we know is there's one finite reality, and that's your portfolio, and how long will that last? So
Mhm.
when I think about the sense of urgency here, it's interesting that there doesn't seem to be the same sense of urgency about protecting the portfolio. And oftentimes I'll ask advisors on a scale of 1 to 10, I mean, you're very good at what you do, obviously. On a scale of 1 to 10, how important do you think the asset management work is and the strategies you build for your client are? And of course, I'll get 9, 10, 11, right? Well, for crying out loud, if that's true and you believe it, doesn't it make sense to protect all that hard work, right? Doesn't it
Mhm.
make sense to protect the integrity of your plan? So, I think the other thing to think about too is when we talk about that dichotomy of if you heard this story from an analyst, the other interesting thing is that as scary as market corrections are, gosh, as long as I can remember, so let's go back, October 19th, 1987, Black Monday, right? That was the crash of all crashes that was supposed to end mankind as it existed. A year later, we were completely back from the brink, and even in the Great Recession and market correction of 2008, within a year the markets recovered. Your body doesn't recover most of the time,
Good
so
point.
there isn't an opportunity to recover in this scenario if this risk happens, and that's what's devastating. You have to look at this as potentially a permanent reality, more than potentially, most likely a permanent reality that will just consume assets. And that's why when you look at the money you have, and let's say you have the assets to perhaps pay for this, you can never create the same level of purchasing power than you can with the leverage of insurance.
Like you said, just insurance 101, that's just the basic power of leverage inside of there. And I think changing the conversation that we have with our clients will lend them maybe to want to have more conversations with us, but still very critical, right? We have to be the one to reach out. We certainly can't wait for them to reach out to us. And there are so many different ways to do that, but I love this conversation around that because it does allow us to change that conversation. It allows us to change kind of the strategy and help kind of refocus them or retrain them to think about long-term care insurance or the planning. Because if you are a financial advisor, we put their portfolios to last a lifetime, right? To not outlive their income. That's a big concern. But like you said, what happens if the body doesn't hold out, and heaven forbid the mind doesn't hold out? Um, now you're looking at the complete erosion of what we've put in place because we didn't find another income stream to protect that portfolio. Because the
Right,
odds aren't that
right.
both of us are going on claim, and certainly not at the same time. And I'm not saying that can't happen because we've all seen the sad stories on the news where it does happen. However, think about long-term care insurance as being nothing more than an income stream to pay for care when it's needed so that you're not using that portfolio to do that. Because all of us, we're building these retirement plans, these portfolios to generate out an income, to live a certain lifestyle that we want to live in our golden years, right? Whenever that starts, which I think a lot of us would love to have those years of reprieve from the day to day grind start younger. But the fact of the matter is, America's not, most Americans are not in a financial situation where they're retiring at 55 and drawing income. If
No,
anything, they're working well into their 70s. And why are we doing that? Maybe for insurance needs. Maybe our health is holding out. We love what we do. Fantastic. But there's still the possibility of an erosion that could happen to that portfolio. And that's really what this conversation is about, is how do we protect that from happening? So if you're managing those monies or your clients, because most folks that buy long-term care insurance are planners, they're planning for the catastrophic risk. So if they're planners and they're visiting with their financial advisor on planning out their income strategies for the rest of their life, doesn't it just make sense that you would need some protection of that portfolio? And so,
oh yeah,
yeah, go ahead,
you
Larry. I
know
think
it,
you've got some
and
wonderful numbers.
I do have some numbers to share, and just kind of give you a glimpse of a real story that impacted me directly. We had a long-term care event in my own home with my grandfather. He lived with us, the last 4 years of his life, and we wouldn't have had it any other way. We wouldn't have done it any other way. He was with us at home. But at the end of the day, first of all, at a high level, the systemic impacts of a long-term care event are broad reaching. As the grandson, we became his caregivers. Therefore, I had to change my job. I had to literally leave a wonderful job that I absolutely loved and found something that would keep me closer to home. So, that's one systemic reality. But the other interesting systemic reality that people often don't think about is, okay, yeah, it's one thing to say that now I have, 7, 8, 9, 10 grand a month of new expenses that I didn't have yesterday. But like in my grandfather's situation, which is true for pretty much everybody that falls into this trap, if you will, is that he was thrust into 2 tax brackets higher than he had been since he had retired at 75. He retired at 75. He's now 89 years old, and suddenly he's back in a tax bracket that he was in his peak earning years because of the distributions we had to take. And that advisor of his fell on his sword. When I got to make the call, you could have heard a pin drop. But let's not dwell on that, but think about the systemic impacts of a long-term care event. And yeah, we did run some numbers, and I find them pretty compelling. I looked at our single pay. I thought that's a great place to start, because oftentimes people think, well, let's just set aside $100,000 or $120,000, and we will dedicate that to our future long-term care need. And if we're young enough, it'll grow and it'll be worth a lot of money, blah, 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 right?
Right.
It doesn't really work out that well, right? Especially if you're having to take additional risk in the market to achieve the growth you need. Well, we know how that works. The timing of your long-term care event could be at the trough of a cycle and you're in trouble, right?
Right.
So I looked at $120,000 because I see a lot of people, slightly more affluent, thinking in terms of, we got 120 grand, let's set that aside. We may need it for long-term care. Well, that's great. $120,000, growing at a, normal rate of return, frankly, doesn't get you too far. So for instance, if I took $120,000 at the age of 55, put it in an investment that would give me I'll just call it a guaranteed after-tax rate of return of 3% by age 80, the 55-year-old would only have $251,000 to draw from. And by the way, that becomes a taxable event, right?
Mm-hmm.
So instead, I looked at a premium for a joint, policy for a couple, 55 years old, equal ages, 5-year policy, basically with the shared benefits. So really 15 years of benefits, more than enough.
Right.
And it's guaranteed to grow at 3% compound as well. So if I take that 120,000, it gives me day one, over $819,000, almost $820,000 in tax-free leverage at that time. And then if I look at down the road, when this age 55-year-old is now 80, that long-term care fund is worth over 1.7 million, actually practically 1,719,000 and change. If I take you all the way to age 85, if they hadn't accessed it, you're just shy of $2 million tax-free. You just can't recreate that, unless you're laundering money or doing something illicit. You just can't recreate that legally, right?
Right.
And I think that's important for people to grasp. And maybe not a lot of us have $120,000 they can single pay. Or maybe, the advisor may want to leverage existing income streams. You brought up income streams, which is a real intelligent way to look at this thing, where you could every year take a distribution, pay the tax on it because it's a smaller number. Mm-hmm. And to create that same leverage, day one, to create that, very similar leverage, I could take this 55-year-old couple could take $4,700 a year, $4,700 a year. Day one, they start funding that. After the first premium is made, they have $819,756. And again, by age 80, over $1,719,000. And that's an incremental way to fund it. So maybe instead they're going to redirect income in an annuity or annuitize an annuity or a series of investments to fund that premium. What we're talking about, though, is an efficiency of capital that can't be matched. And on top of that, creating a tax-free source of liquidity. I can't call it income, right? Because we can't call it income, but it certainly feels like it, And it's certainly a way to mitigate the impact to the portfolio directly, because now your primary source of funding is outside of that portfolio, utilizing insurance, tax qualified insurance, and then you make up the shortfall with a minor distribution compared to the cost of the risk, and your portfolio then will sustain itself most likely, you know. And that's I think kind of the moral of the story here. You know, we come back to its efficiency of capital, efficiency of taxation, predictable, reliable cash flow. You know, that's really what we're talking about.
I couldn't agree more. And it's in that whole conversation with a consumer or with your client. Um, I mean, what a great way to talk about long-term care insurance or extended care planning, however you want to call it, without talking about that. And I'm not saying we're bait and switching, but when you take that annual premium for that 55-year-old couple who maybe has other things, right? The kids in college, kids in high school, maybe the mortgage, things of that nature. You break that down and we're talking about a little over $13 a day. That's
Hmm.
2.5 cups of coffee from your favorite coffee shop a day, right? So, Mr. and Mrs. Jones, are you telling me that, maybe not having those 2.5 cups of coffee every single day um, isn't worth mitigating the risk to the tune of close to $2 million and not depleting what you're working so hard to accumulate? It's just a completely different conversation. And Larry, you and I have so much fun talking around this. And the numbers always play out in the favor of the concept of what we're talking about. And um, I really do look forward to having folks kind of, asking me questions about this, or maybe reaching out to me on the side and maybe wanting a little bit more about this. There are so many power phrases out there in the long-term care space that you can use just to allow you to change that conversation. So it's not the dreaded conversation that we all think about. And, this works so well, the power of leverage for business owners. So everybody's looking for deductible expenses, right?
Hmm.
We haven't even broached that conversation. That's for a whole nother podcast. But um, Larry, any final thoughts that you wanted to add to this before we wrap this podcast up?
Yeah, just a couple quick thoughts. First of all, giving up that cup of coffee a day at your favorite coffee shop, she could probably still go to McDonald's and get better coffee there for a buck and still be able to have everything she wants. But,
Third,
and
right?
that's coming from somebody from
Absolutely.
Seattle, right? We're surrounded by Starbucks. Believe me, I don't go to Starbucks, but that's a whole other subject. I think at the end of the day, especially for any advisors listening to this call who are managing money, this is what I just implore upon you. Think about my grandfather's advisor and think about the assets under management that advisor lost from that one client every month, just shy of $10,000 a month for his care, for two caregivers in our home. And that went on for almost 5 years, just shy of 4 years, right? And if you look at for the premium that we're talking about here, instead of 10 grand a month, maybe for an older person, it might be 8 to 10 grand a year for a couple. That's a big difference. What a way to stabilize the portfolio as opposed to just, rampant liquidation. So that if I can make that image as vivid as I can, that's if you're managing assets and you want to maximize and protect your ability to maximize assets under management, what a great strategy this is.
Absolutely. It's like making sure that everything's got, duct tape on it so there's nobody that can come in and punch a hole in your planning and just start draining out your portfolio of money that you've earmarked for way many, bigger and better things that you wanted to do with that as opposed to paying for extended care. So I appreciate that. That for me, it burns a great image in my mind. And that's really what this is about. It's not about the products. It's not about definitions. It's not about premiums. It's about the storytelling and real stories. I mean, there's plenty of them. Trust me, you can read all the negative ones you want in the media, but there are some great stories out there about how this planning truly does protect families. And that it does work. So, Larry, can't thank you enough. I really appreciate this. I'm looking forward to the next podcast and the topics of conversation. So, with that, have a great day, and we will see you next month.
You got it. Thanks for having me.
Uh huh. Thanks.
Hmm. Bye bye.